Hi, welcome to this chapter 4 of the Little Book of Valuation. If you remember at the start of this book, I talked about the contrast between value and pricing. And in value, I said you try to estimate what you'd pay for something based on its cash flows, its growth, and its risk. Now, in contrast, in pricing, you decide how much to pay for something based on what other people are paying for it. In terms of brass tacks, here's what's involved in pricing. First, you have to find other things just like what you're trying to put a number on that are out there that are priced already. Those other things can be other houses if you're trying to price a house, other stocks if you're trying to price a stock. Second, you can't compare prices across these assets because they might not be comparable. You're saying, what are you talking about? Well, if you have a two-bedroom house and every other house in the neighborhood is four-bedroom, you can't compare the two-bedroom house to a four-bedroom. So what do? You scale the price to the number of bedrooms. In the context of stocks, you scale the price to a common variable. It could be earnings, it could be book value, it could be revenues. You're scaling prices to make them comparable. And third step, and this is perhaps the most critical and the most difficult step, you got to control for differences. In other words, in the context of stocks, if you have higher growth in a stock, you'd expect it to trade at a higher standardized price, a higher PE ratio. You got to control for differences. Easier said than done, but it has to be done to do pricing right. So let's start the process by thinking about standardizing prices, especially in the context of stocks. You can't compare stock prices across different stocks. Berkshire Hathaway will always look more expensive than some small company trading at $3 per share. So to compare the pricing across stocks, you have to scale them to something that they share in common. And that sharing in common has to come from an accounting statement, revenues, earnings, book value, or it can come from something outside accounting statements, number of subscribers, number of users. It's a scaling variable. Now, if you look at the numerator for every multiple, you'll see one of three things. You'll see the market cap, which is the market value of equity. You'll see market value of equity plus debt, a total market value of the firm, rarely. But more frequently, you'll see market value of equity plus debt minus cash. It's called enterprise value, market value of the operating assets. The numerator in every standardized price is always some measure of market, what the market is paying for this company. So if you think about all standardized pricing, the numerator is always a market value. Market cap, market value of the firm, enterprise value. The denominator can be revenues. You're saying, why would I use revenues? Sometimes it's just desperation. If every company in your sector is losing money, the only thing you can scale your market value to is revenues. In fact, if you have a pre-revenue firm, you scale it to things that might give you revenues, number of users, number of subscribers. You can scale market value to earnings. Those earnings can be to equity investors, net income, earnings per share, or to the entire firm, operating income. You can scale it to cash flows. With equity, this can be net income plus depreciation. With cash flow, with the entire business, it can be EBITDA, which is operating income plus depreciation. You can scale it to book value, which is, after all, what the accountants tell you your equity or your firm is worth. So your denominator can be revenues, earnings, cash flows, or book value. Now, there are other choices you'll have to make. Now, one is a timing choice. When you talk about earnings, are you going to divide by the earnings in the last 12 months? Is it over the last fiscal year? Or it could even be a future fiscal year. Right? It's called a forward number. So in part 1b, you're trying to decide what to do. And there again, the choices might be preset for you based on the company you're looking at. If your company is a money-losing company last year, but it's money-making next year, you might use forward earnings because it gives you a chance of computing a PE ratio. Step 2, you got to choose comparables. Now, you're saying, what are comparables? I'll give you the conventional wisdom is if you're a software company, you have to compare it to other software companies, okay? But if you're an entertainment software company, to compare only to entertainment software companies? Now, generally, you might think, being more selective is better. And that's generally true. But remember, there's another thing you got to factor in. The more selective you get, the more criteria you put about what business you're in, small or large, what country of the world, your universe is getting smaller. The number of companies that come through is getting smaller. Statistically, it's better to have more comparable companies than a few. So this is a trade-off that you might have to play with to decide how to pick your peer group. So you've got this multiple, you picked your peer group, you look for differences, and then you got to tell a story The story can be based on risk. A higher risk company should trade at a lower price. It can be based on growth. A higher growth company should trade at a higher pricing multiple. And it could even depend on the quality of growth. A company that's able to deliver growth by reinvesting less should trade at a higher price. That, in a nutshell, is the entire pricing process. Now, there are a few things I need to nail down before we actually talk about the mechanics of pricing. Before you get started, when you look at a multiple, make sure the multiple passes what I call the definitional test. The first test to run is to make sure your multiple is consistently defined. What am I talking about? Remember I said the numerator for your multiple can be a market value of equity, market value of the firm, or the enterprise value, market value of operating assets. The denominator has to be consistent with the numerator. If your numerator is an equity value, your denominator has to be an equity value too. If your numerator is a firm or an enterprise value, your denominator as a firm should be a firm or an enterprise value as well. I've lost you, right? Let's take a couple of multiples. Let's take the price earnings ratio. Most widely used multiple in the world. Numerator is an equity value, price per share, market cap. Your denominator has to be an equity value. Luckily for us with price earnings ratios, the denominator is earnings per share, which is equity earnings. Thank God for small blessings. The most widely used multiple in the world passes the test. Take EV to EBITDA. Numerator is a value of the operating assets, value of equity plus debt minus cash. EBITDA is a rough measure of operating cash flow. That too passes the test. What doesn't pass the test? Price to EBITDA. Even price to sales don't pass the test. Second definitional test, remember you're going to compare this multiple across 15 companies. Make sure it's estimated the same way across all 15 companies. It's actually easier said than done. With PE ratio, you know the question I'm asking you, right? Is the earnings per share estimated the same way for all 15 companies? The defense used to be they're all covered by GAAP or IFRS. They should be the same. We've learned over the last 20 years that you can have the same accounting standards and different degrees of fidelity to those standards. Conservative companies will always look more expensive than aggressive companies when it comes to measuring earnings, even though they're not breaking any of the rules. Second stop is, remember, you're looking at data. The biggest skill set you need in pricing is statistics. Start with the key statistics. Here, for instance, I've reported for PE, price to book, EV to EBITDA, and EV to sales, the standard statistical starting point, summary statistics, the mean and the standard error, right? The average PE for US companies at the start of 2023 was 109.25. Yes, you're doing a second take, right? 109.25, how can that be? The average price to book was 12.4. The average EV to EBITDA was 323. The average EV to sales was 89. You're saying, what the heck is going on? One of the problems with data is sometimes outliers can have a disproportionate effect on the summary statistics. To get a sense of how much the outliers are making a difference here, I computed the median value. The median PE for US stocks at the start of 2023 was 13.92, well below the 109, and I would argue much more representative of what PE ratios look like for US companies at the start of 2023. In fact, I've also computed the skewness, which tells you something about the outliers. In this case, you can see the skewness is a large positive number. The outliers are all big positive numbers. And you can see that reinforced when I report the maximum values. The highest PE for a stock in the US at the start of 2023 was 86,400. The highest EV to EBITDA was 200,500. No wonder the averages got dragged up. One of the first rules when you price things is don't use the average. Stick to the median because the distributions can be skewed by these large positive outliers. Now, one of the better ways of presenting this data is as a distribution. One thing I do at the start of every year is I compute histograms for every multiple that I can for every publicly traded stock out there. So histogram for all US stocks at the start of 2023 of three different versions of the PE ratio. The trailing PE, which is the current price divided by the earnings per share in the most recent fiscal year. The current PE, the trailing PE, which is the price per share divided by the earnings per share in the trailing 12 months of the year. the current PE, which is the price divided by the earnings per share in the most recent fiscal year. See, why they're so different? In January 2023, the most recent fiscal year for many companies was actually 2021. And the most recent 12 months was through September of 2022. Very different ending points, very different numbers. And the forward PE, which is the price divided by expected earnings per share in the next 4 quarters. And you can see with all 3 measures of the PE ratio, you get the same kind of distribution, a peak to the left, a tail to the right. That's what you saw when you saw the average be so much higher than the median, is the outliers tend to be all large positive numbers. You can't have a huge negative PE ratio because the earnings per share, when it's negative, results in a PE ratio that's not meaningful. In fact, when you look at the data, especially with multiples like PE ratio, you'd be surprised at how many companies you lose in the process of even trying to compute a PE ratio. Let me reinforce this with a table that looks at the median PE for US companies over time, with an added statistic, the percentage of companies for which I was able to compute a PE. Remember, in 2004, when I say I can compute the PE for 58% of companies, I'm telling you 42% of companies had negative earnings per share. Over the last 20 years, in spite of markets going up, that ratio has actually become much lower. By 2023, I was able to compute PE ratios for only 43% of companies. 57% had negative earnings. As you look at the median PE then, remember that a big segment of your universe is being lost in the process of computing PE ratios. So define, describe, and describe is basically looking at the data. And there's a reason multiples change over time, as you saw on that table. If you look at the median PEs on the previous page, you notice it starts at 21 and drops, and it goes up and down over time. It dropped to 9.8 in 2008 and 2009 after the crisis. There are 2 reasons why multiples change over time. One is fundamentals. As companies' growth rates increase, PE ratios will rise. As growth rates decrease, PE ratios will drop. But it's also risk. As the price of risk varies over time, as it did in 2008, the price of risk jumped, the equity risk premiums went up, multiples across the board will drop down. From a practical standpoint, though, here are the consequences. The first is comparing the PE ratio for a company today to what it was 5 or 10 years ago. Extremely dangerous exercise because you're not controlling for what's happening across the market. Second, when you do a pricing, it has a shelf life of a few weeks, maybe a couple of months, because as the market changes, the relative pricing is also changing. And finally, there are lots of rules of thumb out there that investors use. Many of them have no basis. They were born in a different time. So when I hear somebody say a PE ratio less than 10 is cheap, maybe that was true at a point in time, might not be true now. Rules of thumb change all the time, basically don't capture the fact that PE ratios change over time. And that's true for every other multiple as well. Define, describe, third, analyze. A lot of people use pricing because they don't want to do what we did in intrinsic valuation, deal with the details of cash flows, growth, and risk. But I'm going to argue that every time you use a multiple, whether it's of earnings or revenues or book value, you are making assumptions about risk, assumptions about growth, assumptions about cash flows. The difference is you're making them implicitly rather than explicitly. Intuitively, firms with higher growth and less risk and greater cash flow potential should trade at a higher multiple than firms with lower growth and higher risk and less cash flow potential. There's a way in which you can look under the hood to find out what the variables are that drive the multiple. And it requires very simple algebra and a very simple discounted cash flow model. So I'll give you an example. Let's suppose you want to see what drives the PE ratio. PE ratio is an equity multiple. Go back to the simplest intrinsic valuation model you can have for equity. A dividend discount model, a stable growth dividend discount model. Boring, but let's try it out. The value of equity in a stable growth dividend discount model is the expected dividend next year divided by the cost of equity minus the expected growth rate. Let's say you divide both sides of that equation by the earnings. If you do that, you end up with a PE ratio. Value of equity divided by earnings is a PE ratio. And if you divide dividends by earnings, you get the payout ratio. The price-earnings ratio for a mature firm can be written as a function of the payout ratio, the cost of equity, and the expected growth rate. If you had a mature dividend-paying company, you can actually compute what's called an intrinsic PE ratio using this, but don't bother because you're going to get the same value you would with a stable growth dividend discount model. Saying then why do we waste our time? Because the three variables you see in this equation are the variables that drive PE ratios for any company, high growth or stable growth. Put simply, when you compare PE ratios across companies, you've got to control for differences in payout ratios, differences in growth, and difference in cost of equity. So in fact, in this table, I've done what I did with PE ratios with a bunch of widely used multiples. PE ratio, growth, payout, and risk are the drivers of the PE ratio. With price to book, you have growth, payout, and risk, and you have an added variable, so return on equity. High return on equity companies tend to have high price to book ratios. So with each multiple, I'm delving into the drivers of that multiple because I need to know this to be able to control for differences across companies. So take a few minutes if need be to look at what drives a multiple before you start using that multiple, because it'll keep you from falling into traps. So we've defined, we've described, we've analyzed. Now we're ready to apply. So let me take an example. Let's suppose I gave you a bunch of beverage companies. It's a very old example, so hang in there with me. And I make a recommendation on 3 stocks that you see on this list, and I call them cheap. One is Todd Hunter, the second is Hansen, and the third is Andre Wine. You're saying, what do they share in common? You can notice those are the 3 companies that trade at less than 10 times earnings. So I'm playing the role of a naive analyst and I'm telling you to buy these stocks. Now you can already see the dangers of going with just the lowest PE ratio companies. There are other things to control for. In fact, in this table, I've given you the expected growth in earnings per share as a measure of growth and the standard deviation in stock prices as a proxy for risk. Remember, high growth companies should trade at higher PE ratios. Higher risk companies should trade at lower PE ratios. So the first way you can use the data is in storytelling. What will this mean? Well, Todd Hunter and Andre Wine, Hansen and Andre Wine look cheap. But Todd Hunter and Andre Wine have low growth, so that might explain why they look cheap, and Hansen has high risk. That's why it might look cheap. Already you can see the dangers with storytelling is story doesn't lead you to a conclusion. You still have to make a decision. So you might say, in spite of the lower growth, I think Todd Hunter and Andre are still cheap. Or in spite of the higher risk, Hansen is still cheap. And that's a tough thing to do when all you're doing is telling a story. So this is the second way you can deal with the fact they have differences across companies. The PE ratio by itself doesn't adjust for growth. Higher growth companies will have higher PE ratios. What if you divided the PE by the growth rate? You get what's called a PEG ratio. I don't like the multiple. I think it has very bad properties, but I can see the rationale for doing what you're doing. In the 3 companies I have, when I compute the PEG ratio, it looks like Hansen still looks cheap, but Todd Hunter no longer looks cheap because scale to the growth rate, Todd Hunter's PEG ratio is 2.98 and the average for the entire sector is 1.80. So PEG ratio, you adjust the multiple for what you most worry about, in this case, differences in growth. Storytelling leads you nowhere. Adjusting multiples leads you somewhere, but there are dangers in it. There's a third approach. Remember I said statistics is the skill set you need most to be able to price companies? I have a bunch of companies here, very different PE ratios, very different growth rates, very different risk measures, right? Hard to make sense of all of the data. One of the advantages when you run a regression is you have a dependent variable that you're trying to explain and independent variables that you think matter. You say, what's that got to do with pricing? What am I trying to explain here? Differences in PE ratios across beverage companies, right? That becomes my dependent variable. What are my 2 variables that I am worried about? Differences in growth and difference in risk. What if I ran a regression of PE ratio against risks, standard deviation, and expected growth? Now, when you run a regression, you got to check to make sure it passes the statistical test. In this case, it does. Both standard deviation and expected growth are statistically significant and have an R-squared of about 51%. What does that tell me? It tells me that 51% of the variation in PE ratios in this sector is explained by growth and standard deviation. Now, don't let your statistics classes drive you into saying, that looks low, only 51%. In finance and markets, if you can explain 51% of what's going on in a sector, you're way ahead of the game. And here's the advantage of having a regression. I plug in for Todd Hunter, its growth rate and its standard deviation. I get a predicted PE for Todd Hunter, and I can do the same thing for Answer. I can compare these predicted PEs to the actual PEs, and guess what? When I do that, it turns out that Todd Hunter is within where I'd expect it to be. The range is close enough, but Hansen still looks cheap. It's a way in which you can get past the storytelling. I'm not suggesting that regressions replace what you do, but they're a tool in your toolkit that you can use to deal with the fact that you have differences across companies you cannot explain. So in this chapter, we talked about pricing. So when you get a chance, try it out on a sector. Now pick a multiple, compute it, see the limitations, let the data drive your decision making. Because this is about using data better rather than theory or finance. It's not what you or I want to see there. It's what the market's telling us about stocks. I hope you found the session useful, and thank you very much for listening.